Good morning. Today is April 3rd, 2022. Thank you for joining me. Excuse me. This today for today's seminar, I decided I wanted to talk about the real estate market cycle and trying to invest around the timing of the market cycle and giving some insight into what we can learn and understand as real estate investors by looking at the real estate market cycle. And I thought, I was under the impression that this was a topic that I had covered before. Specifically, I thought that I had prepared PowerPoint slides and done a presentation before on this very topic. So I was looking through my files and notes and stuff, and trying to find that presentation for me, so I could reuse maybe some of the slides and stuff, and some of the diagrams. And lo and behold, I couldn't find anything. So I'm very confident that I have discussed the real estate market cycle before. But I didn't have any slides prepared. So I am going to talk very briefly about market cycles, and then I'm going to show you a chart about market cycles. And then hopefully we can talk a little bit about how that relates to the Toronto or GTA or Southern Ontario real estate investing market, as it were. First of all, market cycles. What are we talking about when we say that there is a real estate investing market cycle? Well, as you may be familiar with, there is something called the business cycle. Right? In economics, there's the business cycle. The business cycle tells us that in an economy where people are freely trading or exchanging, there is a cycle of business, right? It's not a steady state thing. It kind of, for lack of a better word, it moves in waves. It ebbs and it flows, right? There are times of really good business and times of not so good business, and the in-betweens, right? Where you're moving from either a time of good business to a time of bad business, or a time of bad business to a time of good business, right? This is the business market cycle. In the business market cycle, we have 4 stages, basically, and you will see they're very similar to the real estate market cycle when we look at that in a second. And those are expansion. What are the names of the 4 categories? Expansion, equilibrium, oversupply, recession. I think that's the 4 stages, if I remember. And basically, expansion is exactly what it sounds like. Your economy is expanding, businesses are growing, business receipts are growing, etc., etc. Household incomes are growing. Perhaps individuals are receiving raises, right? They're working at businesses that are growing and they're making more money, and so they're paying their employees more money and they're becoming more productive, and right? So that's the expansion phase. And these are the boom times, the good times. Everybody likes the expansion phase. That's when people are feeling good, right? There's lots of opportunities. Everybody's talking about how good things are and how you can make money and this and that. Things are moving and they're shaking, right? Then you get the equilibrium. So equilibrium is where kind of supply and demand are perfectly balanced in your economy. Perfectly is a misnomer, but they're well balanced in your economy. And so everyone basically who wants a job can get a job, and every employer who wants an employee can find an employee, and everybody's happy, essentially. That period does not last very long, but you get the equilibrium. And then you shoot right past equilibrium and you go to oversupply, right? Where either there are too many people applying for jobs, or there are too many goods looking for customers, or both, in your economy. And so you're starting to have a glut, a production glut, right? You've overproduced, essentially. You've made more stuff than you needed. Now there's this oversupply of things that people don't want to buy, or at least not at the prices that you produce them at to sell at, right? And so that's the oversupply. And then finally, we get to the recession, right? So obviously, now that you've oversupplied all of these things and you have this big glut of stuff, well, now you have to cut production because your warehouse is full of stuff. You don't need to make more, but if you cut production, that means that you you fire or you let go of people. So your workforce, you cut down your workforce, right? Maybe you invest less in equipment and real estate, right? And so all of these things mean that there's less money flowing into the economy. Essentially, everything contracts, right? Contracts. That's why we call it a recession. Everything's recede. And there's a pullback, and this is the time that, of course, everybody feels bad about the economy because people who want jobs can't find them. People who want employees, well, generally speaking, people at this point in the cycle don't want employees, but if they do, they're having trouble finding a good match, right? Like there's a skills mismatch or what have you, and so the economy is going to recede until it reaches a point where supply and demand are once again equalized, right? And sometimes what that means is if you have a glut of production, let's just say you've overproduced cars by 10,000 cars. There's 10,000 more cars you made this year than you needed, right? Well, then next year you won't produce any cars until you've sold those 10,000 extra cars. And let's just say that represents 6 months of sales. Then for 6 months into the next year, you're not going to have any employees in your factory making cars because you need to sell the ones that are in your warehouse. And you can visualize how that works out for the toothpick factory and the barbecue factory and for everybody else who makes things and sells things, and not just makes things and sells things, but if you provide a service, let's say you're an internet service provider, right? Maybe that factory, once the employees aren't there, it doesn't need its Wi-Fi, so it'll be much harder to oversupply things. But that's kind of irrelevant because they still do. It's just harder to see because the way that they oversupply is by increasing their capacity to deliver the service beyond the point at which it is needed, right? So it does still happen to service industries as well. It's more hidden. It's harder to see because they don't end up with a warehouse full of cars or Tic Tacs or whatever, right? So that's the business market cycle, and that is at work in our lives. If you read an economics textbook, it'll tell you that the business cycle runs every 8 to 12 years approximately. It's a tricky thing to say if that's actually the case because the market cycle is heavily distorted by government interventions. Obviously, we live in an era where Keynesian economics were strongly embraced, right? And they encourage market intervention by governments. And so governments are putting their fingers on the scales in all sorts of directions of supply and demand to sort of affect the economy. Okay, hang on a second. Damn. Governments intervene in the economy in a variety of ways that distort the market cycle. Ultimately, governments don't have the ability to really stop or really have much of an effect on the market cycle at all, much in the same way that they don't have the ability to affect gravity. But they can pay lots of money for a plane, and then they have defeated gravity for a time. And similarly, you can distort the market in a way and maybe push a recession back or cause it to happen sooner. This is one of the things why they talk about interest rates in the central banks, the prime rate, the overnight rate. These are ways in which the government is printing or manipulating the money supply, which is a price in itself, to distort these market cycles. Okay, so that's market cycle in a nutshell, the business cycle. Now, the business cycle by itself is not necessarily that interesting to a real estate investor. It does tell us a bit about recessions, and so it's generally a very good thing to be aware of as an investor, period, because that business cycle is going to affect you. It's going to affect your income. It's going to affect your net worth. And more importantly than anything else, the business cycle is going to tell you when there's a good opportunity to buy, right? Every single recession is a fantastic opportunity to buy, right? And the reason why is quite simple. Again, as I explained, the 4 cycles, right? When you get to oversupply, right, which means you have a glut of goods. To go back to my example of the 10,000 cars, right? You have oversupply. Well, we already know, right? One of the few things in economics that is not really up for debate, right? One of the few things that all economists agree on, there is no debate about, is the effects of supply and demand, right? And we know that when we have increased supply and decreased demand, prices fall, and vice versa. So when you reach oversupply and there's a glut, for example, of cars, then we know that by the laws of supply and demand, the price of those cars is going to fall, right? The price of goods is going to fall when there's oversupply. And this is a very good thing for investors to understand, right? Because there's oversupply, goods are going to fall in price. And if you're the person to buy those goods, right, if you have the financial means to buy those goods and hold them until we reach equilibrium, where you can then sell them, you can profit quite massively. And one of the cool things about a recession is that, well, cool is maybe not the right word because it's pretty awful, but one of the things about a recession is a lot of it is psychological, right? That is, people get themselves into trouble with their daily personal finances and that sort of thing, and then they panic, and it's psychological, and then that panic spreads into the market, and now the market is panicking, and the next thing you know, the stock market has fallen 50%. And the thing about that is that usually the market overreacts, it overcorrects, right? So if I don't know, you had a stock that was trading at $100 a share, and then we go into a recession, the market might, for a day or two, not for long, but for a short period, especially at the beginning of the recession, especially when there's a lot of uncertainty, the market might sell that stock for 50% of its $100 per share value, right? $50 per share. Now that stock, a recession is a correction, right? It is the market waking up and realizing that things are not worth what they thought they were. And so the prices need to be reconsidered. And so that $100 per share, by definition, if we're having a recession, was the wrong price. The price needs to fall, right? And maybe the price needs to fall 25%. Let's just say it's 25% overvalued, or let's say 33% overvalued to make it, right? So we need a 25% fall to bring it down. Well, that's going to happen in a recession. But because of the panic factor, like I said, they're going to actually drop the price 50%. So for people who are prepared and have financial intelligence and financial strength, essentially, right, you're in a position, you can now buy that stock or that commodity or that asset for 50 cents on the dollar, knowing that it should actually be worth 75 cents on the dollar. And so you've made a 25-cent per dollar profit, right? So many people get very, very wealthy during the down portion of the market cycle, if they put themselves in a position financially where they're not depending on the income at that period in the cycle, right? Because then they can deploy their savings to buy things at a discount. And ideally, if you buy assets at a discount, then that's how you really, really get ahead, right? Great examples of this are stocks. You can look into the history as recently as 2007, when there was whatever that was, the subprime mortgage collapse or what have you in the States. Warren Buffett got a lot richer, and he bought a lot of stuff at that point in time, right? I think that right around that time was when he bought into Apple. Although I could be mistaken. That might have been a few years later. He might have bought into Apple around 2010, 2011. But I do know that was when he started to look at tech companies, as well as buying into some of the biggest banks, some of who failed during the crisis and got bailed out. He bought into some of those for like 30 cents on the dollar. I'm sure he made a fortune. That's the business cycle in a nutshell. So I am now going to show you a picture. I'm going to present something. How do I do that? Present now, my screen. That's fine. I am going to share with you this picture here. Okay. Just a really simple picture. This is the housing market cycle, or housing business cycle, or real estate business cycle. It's very, very similar to the regular business cycle. In fact, all the labels except for one are the same. Oh, no, I guess not. Two of them are different. Two of them. No. Yeah, two of them are different. That's right. Yeah. So The housing market cycle, right in front of you, for those of you who can see the screen, is divided into 4 quadrants. Okay, and for those of you who can't see, it's a graph with 4 quadrants. It uses all 4 of the quadrants, and we start in the bottom left quadrant, and it is called phase 1, recovery. Okay, during this phase, it says there's declining vacancy and no new construction, so no housing starts. Now, I would like to remind you, first and foremost, that this is an idealized model, right? So that means that this is what you find in the textbook. This is not reality. It's trying to depict reality to give us an idea of what to expect, but it is limited in what it can tell us and what it can show us, right? So when it says no new construction, it doesn't literally mean no new construction, but there's declining vacancy and people are not building very many houses. This is the recovery phase, okay? From there, we move into the expansion phase, which is where vacancies have gotten relatively low, right? Vacancy rates are quite low. You start building new constructions. And so you start to get a lot of housing starts, okay? From there, you move to phase 3, which is hyper supply, oversupply, whatever you want to call it, which is your vacancy rate starts going back up because those new constructions start to be completed and those houses are coming onto the market. And now there is more supply and more competition for each individual owner / tenant. So vacancy rates go up, okay? Because this is called hyper supply, right? Or oversupply, right? There have been too many buildings built. And so the price must come down, right? We must discount these properties because there have been too many built. And so the buildings are now going to compete with each other. And we know from supply and demand that the price will fall. And now that price falling means, the price is falling, right? So now that means there are going to be fewer housing starts because why are you going to build a house if the prices are falling right now, right? It doesn't make a lot of sense. So now the housing starts slow down. You start getting limited new construction, right? And now the prices start falling. And then finally, and then the prices start to fall. So basically this is, to equate it to my business cycle, this is the point at which supply meets demand and then exceeds it, right? All the way through this period, people are feeling good about what the economy is doing, right? And then the prices start to turn and they start to fall. And that is the final phase, which we call recession, right? And in that phase, the prices will fall to the correction point, wherever that is. And then the cycle repeats itself, right? You go into the recovery, you're not building anything new. People are buying up, and slowly the vacancy rate is going down, which is then going to send a signal to the developers to start developing again, and the cycle restarts, right? So first and foremost, just like the business cycle, if you have good timing, this can work out very well for you, right? If you are saving up your capital, right, through phase 2 and phase 3 of the market cycle, pardon me, if you're saving up your money through phase 2 and phase 3, so that you're already in phase 4, which is increasing vacancy, more completions, that's when you're going to be able to buy a house at the cheapest price possible, right? Now, you'll be able to buy a house at the cheapest price possible, but it won't necessarily be very easy to rent. So you have to have the financial resources to buy that house and hold it for a short period of time, right? Let me hide this. So that's basically how you would take advantage of the market cycle. Now, that is the basis of how the market cycle is supposed to work. We live in the Greater Toronto area. As I mentioned before, governments can distort this cycle. And in Canada, our government is extremely active in messing around with this cycle. And so I don't know how useful this information is to you as a Toronto area investor, if that's what you choose to be. because Toronto has not really been following this pattern very well. It should, it would. The economics tell us that it must, right? But we've distorted the market so much that I don't know how easy it is to predict exactly. It'll follow this rough framework for sure. I just could be tricky. Now, the reason I say that, or what I want to explain, or how I want to justify what I'm saying here is, this is an article from betterdwelling.com. Better Dwelling is a kind of slick, real estate focused kind of investing, kind of brokeraging, kind of a online website thing. So they talk about real estate investing, and they talk about just buying a home for like millennials and stuff like that. They kind of straddle those two worlds. Anyways, Better Dwelling wrote an article in 2017. It's actually where this chart is from, right? Because I didn't make this chart. I found this chart. It's online. You can see them in my web browser right now. So that's where this chart is from. It's from this Better Dwelling article in 2017. And it's fascinating because in this article in 2017, right, they predict, well, they say that Toronto is somewhere in between phase 2 and phase 3 of the cycle. And they were saying in 2017 that we were right on the verge of phase 4 recession. Now, 2017 was almost 5 years ago. There has not been a recession. Well, there was a recession in 2020, kind of like a flash crash. That's a result of the COVID pandemic and supply chain disruptions, not so much an actual market correction, right? So we're seeing in the marketplace that, yeah, something happened in 2020. So you could argue that 2.5 years or 3 years after their prediction, something happened. It's a long ways from, we're on the verge. So their prediction is probably not the most accurate, but 2-3 years, it's not terrible. But I would argue we haven't had a correction yet, right? Even though they were saying that we should have. And one of the reasons for that is in Toronto in the GTA. The numbers vary depending on which, whether you're getting your numbers from Stats Canada or whether you're getting them from like university or research or economic paper. But in Toronto, we have what are called, I believe they refer to them as deferred housing starts. What a deferred housing start is basically, if we needed to build, let's say, 50,000 houses every year. And when I say houses, I include condos, apartments, whatever, like units, right? If we needed to build 50,000 units every year in Toronto to keep up with the pace of growth of the population, then deferred housing starts would be those houses each year which did not get built as were needed. So if we needed 50,000 and we only built 40,000, we'd have 10,000 deferred housing starts, right? So in Toronto, the number, again, it varies a little bit, but we have somewhere between 7 and 10 years worth of deferred housing starts in the GTA. That's the number that gets kicked around. I don't know how accurate that is, right? We really have to do the math. A lot of people live in the GTA, so it's believable that there'd be a lot of housing units that you would need each year. And obviously there's a lot of immigration as well, right? And that's obviously adding to the load that you require for housing units. And so this deferred housing, quote unquote, right? First of all, it's completely imaginary BS number, right? Because like you built what you built. The market is building what the market thinks it needs to build. And the reason it's building it is because that's the way the government has regulated the market, right? So the market is doing what is rational in the marketplace based on the rules the government have set up. What deferred housing starts is really saying, or what it's really conceding, is that the government has messed up the market. And these are all of the homes the government has made it impossible for the developers to supply, but which people still require, right? So anyways, we've got all these deferred housing starts, call it 100,000 units or so in the GTA, assuming 10,000 a year, which is probably low, but let's just say. And so those become an issue because when you're in phase 3, right, which is where you actually have quite a lot of new construction, right? And your vacancy rates are supposed to be increasing, while we have all of this pent up demand, right? That's what deferred housing starts means. Right? It means basically this is supply that didn't get built. So we have all this pent up demand for housing that hasn't been built, still isn't being built, right? And yet we're entering this phase of the market cycle, right? This third phase. And so we should expect that prices should correct themselves. But then all of these people who've been kind of waiting on the sidelines are there trying to jump into the market and buy something, which is putting pressure on prices to push them further up, which is a phenomenon that we just watched over the last year, right? Housing prices got crazy. I don't know how much of a running count that I give on this seminar here, but I'm sure at one point I talked about one of my neighbor's houses. I had a neighbor, not a next door neighbor, but a neighborhood house sell for $1.75 million, and I thought that was obscene. In my quiet neighborhood, would never have considered it being worth anywhere near that much. Anyways, that's what it sold for. I thought that was obscene. 6 months later, right, because that was the fall of last year. 6 months later, I now have two houses in my neighborhood, one just down the street, selling for $2.3 million and $2.8 million. Now, those prices are insane. There's no freaking way that those prices are to my mind, that $2.8 million, that's called optimism. I don't see how they can sell it for that price, but I don't know, right? The market is the market. See those prices, see that jump, that's insane. Again, when 1.75 mil was already high, and it was already high, to jump now to 2.3 and 2.8 for houses that I would argue that 1.75 is probably the nicest of the three houses. I don't understand what's happening in the marketplace, right? Except to say that there's still a lot of demand and people are willing to pay, and obviously there's still a lot of available credit, right? That I guess banks are willing to lend to people. They have faith in the underlying value of the assets, I guess, that people are borrowing. Because I mean, at the end of the day, even if somebody makes $200,000-$300,000 a year, if you're going to lend them $2.5 million for 25 years, I mean, they quit their job tomorrow, and then how are you getting your money back, right? You're, as a lender, you're depending on the underlying asset being worth approximately what they're agreeing to pay for it. And I mean, in the case of some of these houses, again, 2.3, 2.8 million, like, it's just, those houses would not have sold for $1.2 million 5 years ago, right? So the idea that like it's more than doubled in value in 5, like, it's just, it goes to show anyways that phase 3, I mean, we probably really are there. And certainly as interest rates increase, right? Interest rates increasing is the exact same thing as the price going up. It's the same thing, right? So as interest rates increase, what we're really watching is just the price go further and further up, right? And as that happens, eventually it will reach a point where it'll start to go the other way, right? The price will have to fall. And that's going to certainly hurt some people who've overextended themselves. So how can we use this as investors? How can we take advantage of this, especially in the GTA? How do we prepare? Well, for starters, the market is very, very hard to predict in the GTA, just because the government is so involved and it is so distorted that really, teasing out exactly when we're going to see the next recession is a very tricky thing to do, right? Like, all of the indicators, more or less, point to an imminent recession. All of them, pretty much. So what does that mean? Like, what was an imminent recession? I don't know. The next maybe 1 or 2 years, maybe. So it's really hard to say. And how much will that impact like the real estate market versus the entire economy? Very difficult to say. Right. And one of the biggest questions is going to be, and how will we recover out of that recession? And that's going to be very hard to say as well, just because in economics, there is a recession and there is depression. And there's also a thing called stagflation, which doesn't usually get talked about because stagflation is very rare. Stagflation is basically an artificial state of affairs that only comes to be, well, I shouldn't say only, but usually comes to be as a result of governments being irresponsible, not anything else. And stagflation is a situation where you enter a recession, but you also have a period of high inflation. And because of this inflation slash recession, you're supposed to have a recession where prices fall, but because of inflation, they do not. People's savings are basically destroyed because the prices were supposed to fall, but they didn't. And then the people's savings are being eaten by inflation. So everybody runs out of financial savings. Without financial savings, you can't invest in the future. So investment dries up. And the economy basically sits there and does nothing. Sometimes it can do that for a very, very, very long period of time. That is a situation that is created when governments are irresponsible with the money supply and they're printing too much money, and that causes the inflation to go on top of the recession. We might be looking at a situation like that in Canada. It's possible. I don't know, right? But it is possible, right? And if we do find ourselves in that kind of situation, a lot of the investing advice I give and have given and you get from other sources is not necessarily going to serve you very well. The best situation you can be in that situation is to have cash flowing assets, right? And have them in a place in a way where you're not going to be exposed to vacancy, right? I hope that is self-explanatory. I mean, it's hard to, how do I put this? In that type of market condition, a lot of people lose their jobs and a lot of people end up broke. And a lot of people, honestly, if things are allowed to play out the way that they should, a lot of people end up homeless. And obviously homeless people are not tenants. They don't have jobs. It's not something to laugh at, but it's the facts of the matter. Now, again, in Canada, we have a very active government. So in that event, they're not going to want to see a bunch of homeless people, and it'll be interesting to see what they do. At some point, well, let's put it a different way. What governments do is they extract resources from people and redistribute them. That's what they do, right? It's actually not what they used to do, but for the last 100 years or so, that's what they do. Because all governments are socialist governments now. That's something that doesn't get talked about. We talk about socialism and capitalism and these various things, and yet nobody ever frames the conversation correctly, which is that almost all modern governments are socialist governments, right? So to one extent or another, and they redistribute wealth. That's basically what socialism is. It's not a good thing, but we're doing it anyways. And the reason why it's not a good thing is very simple. It distorts the market and it allows you to live in fantasy instead of reality. And you are seeing the consequences of this everywhere all the time right now because people want to live in fantasy, and we've been paying them money for a long time so that they live fantastical lives instead of realistic lives. And what I mean by that is that your income does not need to be coupled to your productivity. Right? There are lots of people who work, for example, for the government who do nothing productive whatsoever. But, they're going to continue to get their income. And if the economy collapses, right, the government is still going to try to pay those people. Right? It might increase taxes. It might take out debt. It might whatever, but it's still going to try to pay those people so they can continue living the fantasy where they go to work and they move paper from one place to the next, but they're not actually productive. Right? And the whole economy, the whole market cycle, that whole thing is about allocating resources to the parts of the economy that are productive. And the purpose of the government is to do the opposite, to allocate resources according to the whims of the government, basically. Well, who cares about productivity or that sort of thing? So it'll be interesting to see how our government in Canada responds to the economy failing and whether or not they attempt to redistribute the wealth more or not. If they do, they will effectively destroy the Canadian economy because really it's in a lot of ways, it's already on the brink. I don't think people realize just how precarious in some ways the Canadian economy is. Like a huge proportion of the Canadian economy and GDP is real estate. Huge proportion of it. You think about a realtor who sells $1 million house, makes a 5% commission, split between him and the listing agent, split between him and his brokerage. So he gets whatever, 2.5. He gets 1.25% of that $1 million house. So he sells that one house, walks away with $12,500. Right? Sells 6 houses a year. That's it. You're set. One house every other month, kind of a thing. You've made a pretty decent income, right? You sell a few more than that, or if you sell a couple priced a little higher than that, you're doing twice as good, right? So that's a lot of the economy. There's a lot of money flowing just from the realtors selling stuff, right? And taking off their little commission. And of course, there's a lot more that goes into that because they have support staff, secretaries, all of these various people, right? So what happens if there's a year where just like there are no sales? Some of those realtors are so successful or so financially prudent, it's no big deal. They can survive a year without making any money, right? A lot of them, however, are regular people. They require their monthly income to come in and cash flow for them so that they can pay their rent and their bills. And they won't be able to. And then what happens? And when those rents and those bills go unpaid, what happens to the people who took that money to pay their rents and bills? And you can see how that has a big knock-on effect. So it's certainly a point of great risk and concern in the Canadian economy. And it's something that is really, unfortunately, it shouldn't be down to government choices like this, in the sense that they should not be distorting the market like this. It's not a smart thing to do, for so many different reasons. But you know what? Your average person doesn't spend any time thinking about the economy or investing or money or any of it. So they don't understand what a dangerous and silly thing we're doing. They really don't. And just as an aside, historically, when governments have done what our government is doing, the way that they get themselves out of it is by starting a war, because they've created a situation wherein the people are going to suffer, and that means that they're going to get their butts kicked out of office. But if you start a war, the people still suffer, but you blame that suffering on the people you're fighting the war against, right? Rather than on yourselves, even though ostensibly you're the cause of the harm. Either way, right? So just something to keep in mind, okay? That is the housing market cycle. Now, the last thing I want to talk to you about is show you. I'm going to cut it a little quick here. So my stomach's bothering me a little bit here. But I'm going to just quickly go over this. So I included this link in today's email. So if you are interested, you can just go and click the link. This is yours. I believe you can even click on, I'm not sure if it's the share button or what, because for you, the screen will look a little different because you didn't make the sheet. But there is a button there that allows you to save a copy to your own Google Drive. So, you have it. It's separate from me, kind of thing. So you can do that if you want, or you can just use this one. Either way, it doesn't matter. I've restricted your permission. If you use this one, you're not able to edit most of it, because you might break it for someone else. But here, this sheet's really, really simple. It is just a mortgage payment lookup table. So over here on the left-hand side, can I hide these? Yes, I can. So over here on the left-hand side, I have a table. It says 15, 20, 25, and 30 years. Those are your amortization, right? So how many years are you amortizing the mortgage for? And then down the left-hand side, we've got interest rates. So we've got from 1.75% all the way up to 7% interest rates. So you can look here and you can predict, or you can really quickly determine what your payments will be for any given interest rate and any given amortization combination. Well, within reason. So just to give you an example of how this works, this is per $100,000 borrowed. Right? That's very important to understand. It's per $100,000 borrowed. So if I borrow $100,000 and I amortize the loan for 25 years, I will pay $412 per month according to this table. That is what you'll pay if you put it into a mortgage calculator as well, right? If I amortize it for 30 years, I'll pay $356.93, right? And oh wow, I didn't round the first three tables, but I rounded everything else. Okay, well that should be 357, that should be 370, and that should be 382. But anyways, I just gave you the exact calculation for those three cells. But all the way across the table, that's what it does. So if you wanted to get a mortgage at 5% at 25 years, there it is, $582 per month per $100,000 borrowed. So if we were going to do $1 million mortgage, we would multiply 582 by 10. You're going to pay $5,820 per month to borrow $1 million amortized over 25 years, and you'd pay $5,340 per month amortized over 30 years, right? So this is a very quick and easy way where you just look at a property, you say, boom, it's, I don't know, it's $800,000. I'm going to put 25 down, so I have a $600,000 mortgage. Okay, find my number, what's my current rate and amortization, multiply them together, you're going to have your monthly mortgage payment. Of course, that is a lot of thinking, so you might not want to do that. Sorry. So I just set up a really quick little table here. If you want, you can go here. You can pick from the drop down your amortization. You can type in your interest rate. You just punch in whatever. Sorry, I'm on the wrong keyboard. You just punch in whatever you want. So 4.25, let's just say. I think that's an option. Yeah. Your down payment percentage, and then your purchase price. And it'll automatically subtract your down payment, divide by 100,000, and then multiply that by your find your interest and your years of amortization and get that payment, multiply it by the number of hundreds of thousands of dollars you're borrowing. If you'd like, you can also add in your taxes and your insurance, and it'll tack those on to give you a final monthly payment. So just a really quick way to look things up. It's not a full analysis. Sometimes, I understand you sit down, you just say, well, can I afford this kind of a thing? I don't want to analyze. I don't need to know all the ins and outs, but I want to know what it would cost me to buy this thing, right? So this is a really quick and easy way that you can see what you're going to end up paying for a property on a monthly basis. And also you can do a little bit of what if analysis, right? If you want to say, okay, I'm going to buy this at a 2% interest rate, but what if my interest jumps to 3%? Well, you can plug those numbers in really quickly and find out what that's going to do. I put this together in Google Sheets for myself. I just wanted a quick lookup table. You can find these on Google. People have made them. I wasn't finding what I wanted, so I just threw one together. Really, it's pretty simple. You just go into a mortgage calculator, say your mortgage is $100,000, start playing with the other variables and make your table. So I did that, and I made this table, and I thought I'd share it with you because it might be useful. I sure know I get some use out of it. So it's very, very simple and straightforward. Again, the link is in the email, and all you have to do is open it up and use it. Because it's on Google Drive or Google Sheets or whatever, you don't require Microsoft Excel to use it. I didn't need any of the more advanced functions, so Google Sheets will do just fine. And that allows you to have it anywhere, right? You can pop this open on your phone, pop it open on your on anybody's computer as long as you log into your Google Drive, right? If you've saved the copy of it or whatever to your Google Drive, then you're good to go. So hopefully that's a tool that you find helpful, just to kind of get a better understanding of what your payments are going to look like and what your financing situation is going to look like. Obviously right now, interest rates moved one time this year. They will probably, all things being equal, they'll probably move again between now and the end of the year, maybe even twice. If the Bank of Canada holds true to their statements, it will move 2 more times this year, but we'll see if they manage to be. But at least this way you have an idea of where interest rates are going and what's going to happen with them, and you can really kind of plan ahead a little bit, right? Certainly, talking about the business cycle, it's a little bit scary, right? To talk about, well, the things will crash, maybe prices will fall by 30% and da 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 da. And obviously, if you're looking to buy, that could really negatively impact you, right? We're trying to invest here. We're not trying to lose 30% or even 10%. That's within reason. That's obviously a short-term position. Real estate is a long-term play. Maybe a recession might affect housing prices for the next 5 years, right? And then after which point the prices will begin to appreciate again. So if you buy a property and you need to sell it in 2 years, yeah, that recession might really hurt you. But if you took a longer-term vision, then that recession, you might not really notice it, at least in terms of as it relates to your housing value, right? So if you buy houses, as I counsel pretty much every week, if you're buying houses, that cash flow, or I outside of the GTA, I recommend your houses should cash flow for sure. Inside the GTA, it's a little trickier to actually make that work. So if you're buying properties in the GTA that don't cash flow, that's acceptable, right? But you probably want them to be right around that break-even point, right? And the reason you want to be around that break-even point is so that they're not costing you, right? Unless if they're vacant, and even properties that cash flow might cost you when they're vacant. That's the nature of the game. But if your property at least breaks even, right, that means as long as you can keep it tenanted, you can more or less keep it. And obviously, if there's a recession, right? I mentioned the economy tightens up, people lose their jobs, and their access to credit. And so as a result, when there is a recession, the demand for rentals tends to increase, right? The demand for rentals tends to increase, even though the demand for new homes and new units tends to fall. So if you're in a position where you own property that's cash flow neutral or slightly cash flow positive, then you're probably going to see your rents increase to make that neutral into slightly cash flow positive, and that slightly cash flow positive into maybe potentially quite cash flow positive. And so you should be okay to ride through that recession without really worrying about the fact that your asset declined in value, right? It's similar to, forgive me, it's similar to if you own Coca-Cola. Right? If you own Coca-Cola shares and you're getting that sweet sugar dividend, 30 cents per share, whatever it is every quarter, and that's how you make your income. Like, let's just say you own, I don't know, 100,000 shares of Coca-Cola, and you're getting 30 cents per quarter as a dividend. So that's $30,000 per quarter. It's $120,000 a year of dividend income from Coca-Cola, right? That'd be really good. And if the value of Coca-Cola dropped 30% as it did in 2007, but the dividend remained the same, but the value of Coke dropped that much, would you care? The answer is, of course, no, because you still get your $120,000. And at the end of the day, and I know Coca-Cola is not going anywhere, and Coca-Cola is going to be bigger and better than ever in 2015, even if it takes 2009 and 10 to recover from the loss it had in 2007, right? So you have to have that same mentality with the real estate. There's a fantastic book I highly recommend that is called Unshakable. It's by Tony Robbins, and it's his book about investing. And it's basically him sitting down with a couple of investors, and it's kind of some of the things that they've taught him over the years, and he's learned himself becoming an investor. For those of you who don't know, Tony Robbins is a big time investor, actually. Not like a Warren Buffett, but in his own way, his life has led him to opportunities that have allowed him to be an investor and to make a lot of money that way. And obviously he's gotten to meet a lot of really great people as well. And so some of the lessons that they've taught him about real estate investing, or not real estate investing, I'm sorry, he focuses on the stock market, securities, on securities investing. Are in that book, and it's a really good book. And one of the key lessons, the title of the book is Unshakable. One of the key lessons is basically make investing decisions that you are confident in, to the point that when the whole world is telling you that you're an idiot, you're not bothered, because you've made quote unquote unshakable moves, right? And that is something that's very important, right? I'll share really briefly. I had somebody, we were talking to somebody about real estate investing, potentially maybe partnering or doing future investments together. And we were talking about a property that we had, and we were explaining to them, how we bought the property, how we'd done the repairs, and brought active appreciation to the property, and how this was how much money the property was projected to cash flow. And as we were sitting there talking to them, we explained to them we hadn't yet seen that cash flow because we still had a few vacant units in the property, and this person started to, excitedly explain to us how, we got to be careful about losing our money. Oh no, you got to get tenants in there, be worried about the tenants. And obviously this person, perhaps a bit of an idiot, but they think that they're helping, right? And obviously we're in a position as investors who've done the due diligence and made good decisions where the house is worth double what we paid for it. And if a tenant doesn't live there for an entire year, it sucks for sure, but we're not losing out, right? So those are the types of things where you have to be, you can't be second guessing yourself, right? If that person gives you pause and makes you think, oh no, did I make the right decision? Then you may not have made the right decision, right? When I receive that criticism, it's almost like you laugh at the person. It's like, oh, you're very naive about how I conduct business, right? Like, okay, so you would put yourself in a position where $1,200 is going to hurt you, but I've made smarter investing decisions than that. So, $12,000 isn't going to hurt me at the end of the day. I mean, it'd suck. I want that money because I can buy whatever with it, right? I don't want it to be wasted. But I'm also not putting myself in a position where I'm on the razor's edge and you telling me I made a mistake is going to send me psychologically spiraling. Because a lot of people do that. You see it with the stock market. Again, to go back to start the seminar, talk about the business cycle and people investing in the stock market, there's that panic moment where people who have basically positions that they haven't thought about very hard, that they haven't reasoned, that they are not unshakable on, well, there's a shake and those people get shaken and they get shaken right off. And sometimes they end up losing a lot of money. Like I said, the correction might be 25%, but a lot of people will sell down to 50, right? Because they're panicking and they didn't know what it was worth. And I mean, you go ask people, you go ask anybody who has investments, right? Ideally stock investments, because those will be the easiest ones. Just ask them, what's your investment worth? They don't know. They will tell you what the market values it at today, right? If you ask somebody, they'll be like, oh, I invest in Tesla. You'll be like, oh, yeah, what's that worth? And they'll be like, oh, I don't know. Let me get my phone. And they'll pull out their phone. They'll be like, well, I have 25 shares and they're worth $1,000 each. So it's $25,000, right? They don't know. And if tomorrow the price falls $200, they might panic and sell, right? Because they don't have an established value for themselves. They're just looking at the price and they oh, that looks good and buying and hoping that it goes up. That is not the correct way to invest, right? So you need to understand what you're involved in. Once you've done that, really, the rest will sort itself out. Even if you don't get around, you can definitely overextend and get yourself in an uncomfortable situation. You got to be careful about that. But again, if you're investing for the right reasons, looking for the right things, you can make money at any point in the market cycle. That's something that's very important to understand. And something that's very interesting, just to go back to the Toronto market cycle before I end the seminar here, is in that Better Dwelling article where they're talking about the coming recession and the prices. One of the things that they point out is that you start to see prices getting discounted right before you have a recession. And they were predicting recession 2017, right? So they were saying, well, we're seeing this price discounting, which of course, if you remember 2017, I don't recall any such discounting, but perhaps. Well, their argument is, and it's a very good argument, developers were offering overseas buyers discounts on the prices of these units that were being built in Toronto. Up to 20% according to them. They have some pictures of some like Facebook stuff from China. Looks like maybe that's really what was going on. So pro tip, if you want to invest in a condominium, spend a couple dollars on a VPN and see if you can access those websites from China. And it might be possible that you'll be offered a discount that you would not be offered as a Canadian citizen. Don't ask me how, why, or what that's about. And I'm not sure if legally your VPN will work, because the VPN will get you access to the website where they might advertise the offer to you. But at the end of the day, you are Canadian and blah, blah, blah. And there might be some legal, stupid government reason. Would not shock me at all why you can't get the discount, but these foreigners can, because that sounds like the kind of thing the Canadian government would do. So something to be aware of, right? But that is a way as well that discounts can be hidden from the marketplace, right? You are a consumer, but there are different levels of consumers, right? And obviously, if you're in a position where you're the kind of person who goes to a condo development and you buy 10 condo units for resale for assignment, you're a very different customer than the person who's buying one unit, right, for rent or whatever, right? So you need to understand that. So maybe the discounts are going to that bigger, that bulk, that volume buyer, right? It's possible. So just something to be aware of. Sometimes you won't see that stuff, so you can't necessarily just depend on like a straight chart of prices and that sort of thing. And I'm going to stop there. That is the real estate investing market cycle, right? And that is how it relates to your investments in your life and what you need to know about it. It's good information to be aware of, and then to take action around, right? And so specifically, like for myself, just real quick, for myself, the action I try to take around this information is saving. I try very hard to save a lot of my income. I try to live very frugally, because there's a recession coming. I missed 2007 pretty much. Young and dumb, didn't have a lot of money, just finishing university at the time, I think. I don't even remember. No, I guess I was more or less starting it. No, I was kind of in the middle of university, wasn't I? 2007, 2008, I just started. So I didn't have any money, so I couldn't take advantage at all. And obviously the world looked very hard and difficult. I don't want to miss out on this next recession, so I'm prepared for it. Right. So anyways, that's it. I hope you have a wonderful weekend, wonderful week, and hopefully I'll see you again next week, either on YouTube or here on the live stream. So thank you so much for your time, and have a wonderful day.